Hey guys, thanks for joining us today. We're going to really get into something super, unique, something that I'm sure you've never heard before. Well, we're talking to one of my longest term friends, longest term clients, has raised, I don't know, Eric, what have you raised? 100 million? Two?
Yeah, probably around 500 million in equity from 2009 to present.
That's it? You bum. So no, I'll get a little bit more into your background in that, but I'd like to kick it off with a few stupid jokes for you. My financial advisor asked me, what's my net worth? I told him I don't have a net. Here's another just stupid dad joke. My financial advisor said, I need to be better with my money. So I fired him.
That's good, Nate.
I know, just pure ridiculousness. But no, better introduction. Please welcome Eric Mattingly. And thank you so much for joining. God, I don't even know how many deals we've done over the last decade and a half plus.
Close to 100.
Time flies when you're having fun. You had more hair when we got started, and I had less gray when we got started.
Yeah, and what I do have is gray.
And congrats, you've only raised $500 million in equity. That's pathetic. I don't even know why we got you. Just joking.
Well, not by myself, but just collectively as a company.
And your company is what?
DMI Holdings. Our website's investwithdmi.com.
Absolutely love it, and thank you so much. And of course, I'm Nate Dodson. I'm the principal over at Crowdfunding Lawyers. We do help syndicators, sponsors, the management side doing the capital raises, acquiring businesses, acquiring real estate, starting up companies. And, we're going to be talking very specifically about the sales process today. Eric's going to share a little bit of his secret sauce, one of those things that you just don't see very often. And, if you are interested in getting a little bit more information kind of about how to do deals, how to structure them, how to get them launched. We're really focused right now on the sales process, but let me just share this real quick. This is a QR code. Go ahead and you can scan it. It will take you to a free download, kind of a securities instructional manual. We'll drop in chat the direct link as well. But just to kind of share, hey, get some more information, learn how to raise capital legally, the safe, the smart way. And without further ado, Eric, I gave a little bit of a background. Is there more that you'd like to share and
Sure.
just about your background? And then we'll get into the presentation.
Sure. Well, first of all, Nate, I appreciate you inviting me on here. And, as I shared with you the other day, I'm really kind of at a place in my life where I'd like to earn on investment. So that's another big differentiator is, you're really getting your money back out of a hole in the ground if it's able to even do that. And there's so many challenges and problems along the way. I just never saw any investors have success with it.
So that's an emotional sale. Buy now, you lose the opportunity. You potentially got 10x. You potentially have losing everything.
Yep.
How's that compared to like a business startup?
Well, I mean, it's similar and it's different. I mean, we haven't done a lot of true just startup like angel investing type of things. We typically would look for companies that, had an existing track record, a location or two, and wanted to open multiple locations. So they wanted to expand, focus on operations. We're looking for an equity partner. And, really, at least you have that to go off of. Past performance doesn't dictate future results. But, if there's nothing there, all business plans look good. and all the projections look good, that doesn't necessarily mean that you're going to meet any of them. It is very speculative. However, at least if you have a business that's operating 1 or 2 locations, you can make an evaluation based on what they've actually done, and then the business plan, and then the projections. And you just try to make it as conservative as possible, and put in your own assumptions that dumb things down, because the business owner is always going to be generally more aggressive. And so there's certainly more risk investing in a business if there's no real estate involved than there is investing in a real estate opportunity.
But where you're saying the oil and gas is more emotional, if you had a tag, like, is it more analytical or a slower sales process?
I think it's a little bit of both for a person that's going to invest in a business. So we do business expansion opportunities. We don't do startup business opportunities. So, people are going to, it's really kind of the same type of investor. They may just not want to invest quite as much. I mean, they're going to, quite frankly, they're looking for the upside. So their investors are expecting larger returns. They're going to evaluate the opportunity. If the business is local, a lot of times we'll do, facility tours to give them an opportunity to see it. If not, we usually also do virtual tours, similar to like a real estate home. You can walk through to get a general idea of the quality of the business. More importantly, I think the thing that they're looking at really is, because we're not the operator, we are always the equity partner. We partner with an operator. So the operator is a big part of it, really understanding what their background and their track record is, prior experience in the industry. So it is, I think, a little bit of analytical evaluation from an investor standpoint. And we invest in all of our own projects. So, it's the same thing that I'm looking at. We try to convey the same things that we look at to the investors. And then it's the excitement that, a business could be highly successful, and there's a huge opportunity for kind of a big windfall or an above average return on investment.
All right. Well, let me ask you about the other asset class that has been a big focus for a lot of us.
Mm-hmm.
Acquiring real estate, specifically multifamily, but there's been all different types of deals. What's the different spin or considerations thinking about real estate with a hard closing date versus the business versus oil and gas?
Yeah. I think you and I have probably done, 30 plus multifamily deals together, and more offerings than that. Some of the projects we did had more than one offering, but multifamily for me is probably my favorite asset class to invest in personally. I personally invest. The thing that I really like about multifamily, and investors like, we try to keep it simple, and I don't have a slide deck to work with today on it, but there's some fundamental real benefits to investing in multifamily. So just kind of high level, in a multifamily investment, provided you're in a normal interest rate climate, we do both value add acquisitions and new construction. We've done more of the value adds than we have new construction, but we've had good success on both. And with a value add, you're going in and there's an opportunity to bring value by reducing expenses and increasing the income. The value of the asset is based on the income that is being generated, versus single family, where it's based on comps, what people are willing to pay in any given market, just the buying and selling activity that's going on. Multifamily is based on the income. So if you can increase the net operating income, you can increase the value, which really gives you a lot of opportunities. Generally, the business model on a value add would be a 5 or 6 year business plan hold. Or at least that's the target, to be able to return investor equity. Normally, you would do that in about a 3 year period of time and refinance. Ideally, you can return about 50% of the capital. Sometimes it's less. Sometimes you can't refi. Sometimes it's more. We had one project, if you recall, on Enclave. It returned 100% of the equity, just a little over 5 years. We held it for 7 years. And investors had no money in it. So it's one of the unique features is that you can wind up owning an asset without an investment of cash due to refinancing and loan proceed distributions to return investor equity. still get tax benefits, still get cash flow, and then have an upside. So the projects that you're able to pull all the investor equity out, which might require a second refi or a supplemental loan, it makes sense. You don't have any money in the deal. There's nothing at risk anymore. Why not hold it longer term and sell it for a greater upside in 2021 and 22? Collectively, we had ownership in a number of properties that we held for that period of time, and investors hit a home run, sponsors hit a home run. It just, it's, to me, plus you can create income. You usually don't have high income in the first couple of years until you hit that refi point. And then once you have some capital returned, your basis goes down, and then your return on invested capital at that time goes up. That's usually when a multifamily project is going to be able to get you in the double digits on cash returns, distributable cash.
Love it. And I know you're still doing some multifamily deals. You're still working with some investors. I know a part of it is always what's happening in the market. What does the crystal ball say? What's your thoughts? Just kind of what's going on today versus the outlook going forward?
Obviously, the interest rate climate has made things very challenging for multifamily investors. Last year, we did one new construction deal with a HUD loan at a low interest rate. No value add acquisitions of any kind. Sometimes the best deals you do are the deals you say no to. So you might look at 100 deals, and if none of them make sense, you need to say no to all of them, even though you might want to do the deal.